The markets continue to suffer from a very rare but life-threatening disease that we call loft as traders. That's L-O-F-T, lack of follow-through, if you will. And although I don't have a medical degree, I certainly think that after walking through today's data points, we can all conclude, bulls and bears alike, that this is a very reasonable diagnosis. So let's do that now. Of course, before we get into it, anything that we're associated with is linked down below in the description. Quick thumbs up and subscription on the channel is a great way to support us here. And stay tuned until the very end. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, once again, we have another green-bodied inverted hammer. So just like last week, it's not really giving us any edge in terms of who's in control from the structural perspective. We know that there are some sellers hanging out towards the top of the weekly range, pushing prices lower. But because we have a green-bodied bar, we closed in the midpoint of the weekly range. We did not reattempt the opening print. There's also not a whole lot of lower wick to read into that would indicate any sell-side pressure early on in the week. So not so clear from a structural perspective. If we think about location, things also are not clear here. On the bar-to-bar count, yes, we did technically produce a higher low as well as a higher high, but where have we closed? Right at the top of the prior week's range, not above the prior week's range. We've also closed right on the weekly 50 SMA, that's the blue moving average on your screen, and just note that usually the first test is the best test. First test, we've obviously chopped through it a number of times in here. It's losing its importance as a structurally significant weekly level, so we'll carry that forward as more neutral than anything else. In terms of other structural elements we've been focused on, the back test of the weekly resistance trend line here was bullish, looking for positive outcomes. The failure of that became noteworthy, and now just like the 50 SMA, now that we've chopped through it a number of weeks in a row, it's becoming less and less relevant to our analysis. If we take a look at our support trend line, obviously this was looking bullish on the back test here. The breakdown was bearish, and we are underneath in the upper wick. This is slightly more relevant and would stack up as a bearish data point. What's slightly more bullish, though, you can see how we're getting all of these conflicting signals, is if we take out the Fibonacci's from the low to high of this range, we are technically back above the 38.2. Now, granted, it's not like we've closed definitively up here. We're certainly not threatening a break of the top of the range, but we are nonetheless above the 38.2, which is a slightly more bullish than bearish data point. If we just recall also our structural element right around in here, we've closed above the 390 zone of importance, if you will. The high volume node has migrated slightly higher, but before we take a look at that chart, let me just remind you of our anchored VWAPs on the weekly. Here's the all-time high anchored VWAP. Here's the October low anchored VWAP. We're in the midpoint of the VWAP band. So bears, of course, didn't really make any material progress underneath the low of the band, and it's obviously not as, positive as it could be spending time above the top of the band. As simply put as we can say, it's in the midpoint of this range, which isn't really all that informative here on the weekly time frame chart. Let's go to that high volume node now and just explain that it has technically migrated slightly higher here to roughly 395 as of the close of the past week's worth of trade. Obviously, the volume here being produced by the hysteria in the banking crisis, if you will, dragging that point of control slightly higher from a volume perspective. Now, what have we been saying in the past? This is not an area to initiate new trades. This is technically where there's the most liquidity. This is where the market's most content. As we start to move through low volume voids, we start to target the next overhead high volume node, or in the opposite sense, as we move through a low volume void underneath us, we start to target the next high volume node underneath us. It's not an argument that obviously we're going here in the coming weeks worth of trade or even here, but we're saying that, in this general zone right here where there's the most liquidity, it's going to be a fairly choppy market. And let's just be very, very clear. If we zoom in on this and take a step back for just a moment, we've been analyzing the short-term trend from here on. We have lows, we have higher lows, and technically we have produced a very nuanced higher low, which would be bullish. But if we just think about the market in terms of a slightly broader time frame like this, is the market really trending here is the question, and the answer is no. It's range bound, and although it's not technically smack in the midpoint of the range, it's closer to the center point where, once again, we know there's a high volume node, and you don't technically have an edge here whenever we're dealing with a range. We have an edge at the top of the range for a breakout or mean reversion, and the same is true but opposite at the bottom of the range here and here. And as I called out in last week's episode, it doesn't mean that we just throw our hands up and surrender to the market and say, hey, that's it, we're just going to do nothing until we get to the top or bottom of the range. It's just a context thing that would tell you I would not be married to any particular direction on the weekly time frame chart in terms of what needs to happen next, right? Things will become much more constructive as we trade above roughly 420 or underneath roughly 350, right? We're just not there as of right now. So I think the shorter duration time frames are where you want to be paying attention to stronger signals and not being overly attached to any particular outcome for this market in this environment, so to speak. Now, the risk on the weekly time frame chart before we go to the daily and get a little bit more granular is still that we form a head and shoulders pattern, and when and if we crack the neckline at 380, we will of course change our tone and look for some more downside outcomes. As of right now, it simply has not happened. Let's get a bit more granular on the daily time frame chart. First up, evaluating the weekly expected move. If you're not familiar with this study, top right-hand corner's got you covered with a brief tutorial. If we're contained by the upper edge of the expected move, the number is roughly 405, and it's suggesting a higher high being produced from a trend count perspective that does strike me as being more bullish than bearish. If we're contained by the lower edge of the weekly expected move, the number is 386.60, and once again, it's suggesting a bullish implication here with a higher low being produced from a trend count perspective. Now, don't get me wrong, if we do move all the way to the lower edge of the weekly expected move, it would be a breakdown of last week's low, which wouldn't be the most bullish implication, but as long as we're contained by this, the higher low does strike me as being much more meaningful. You could chalk it up and say, okay, maybe at best we're bullish, but really it's more neutral. That would be a fair assessment as well. But you guys know me, I'm the perma bull of YouTube, so we'll call it what it is. To me, it's a little bit more bullish. Anyways, from a trend perspective, we are still technically in a daily downtrend with highs, lower highs, and as we discussed in Wednesday's video, lower highs were found on the FOMC sort of top, if you will, right around that structurally significant area of 401. Prior resistance from here, support, resistance, right? So no surprises there. It was a rejection of the daily 50 SMA. All is well and good. However, from a trend perspective, I would at least entertain the opportunity for a daily higher low to be found here at 389. We'll talk about why on the hourly chart in just a moment. What else strikes me as significant here on the daily time frame? Well, we've recaptured the daily 200 SMA, but just as we discussed on the weekly time frame chart, the more you just chop and slop right through moving averages, the less relevant they really become. I think structurally the most significant thing here is the close back above 390, 350. This is really a tale of two ranges, if you will. Here's an upper range and here is a lower range. You could classify this as one big range, and then the midpoint is the sort of dividing line between the two, right? So that's 390, 350, and the close above on Friday does strike me as being slightly more bullish than bearish. We know that we're in an hourly uptrend here, so we'll talk about that stuff in just a moment. But before we go there, let me point out that from a Fibonacci perspective, we're in no man's land, and this kind of more aligns with what we were discussing on the weekly chart, that there's not really a whole lot of constructive edge in between the 38.2 and the 61.8. You can see that we get chop and slop in here. We call this no man's land. Bulls are more, productive above, bears are more productive below. Obviously, that failed to materialize on the Friday session. We'll clear that up and bring up our anchored VWAPs from the October low and onward, anchored to all the significant pivots. So low, high, low, and high in here. Notice that in the VWAP range, we're just in the midpoint. So as we discussed on the weekly time frame, it's really neutral. It's no man's land. Bulls are more productive up here. Bears are more productive down here. We don't have either as of the close on Friday. So all well and good from the daily perspective. We know that there's really a lack of clarity in this general zone. But if we go to the hourly chart, a couple of things become abundantly clear here, and it's really the failure patterns on both sides of the trade, right? So here is the most recent balance range. We have a look above and fail. Did we get to the bottom end of the range? Absolutely not. So the sellers did not complete their job, but the buyers didn't get continuation in the first place. So there's your lack of follow through. Second time around, we get a big break at the top of the balance and it fails back into the balance. We should technically move to the bottom end of the range. Does it take place? Absolutely not. So lack of follow through from the sellers, but also lack of follow through from the buyers to keep it at the top and above the prior range in general. So there's a whole lack of clarity here from a pattern perspective, from a follow through perspective. The other thing that I really want you to focus on is what took place on Friday's session. And this is why I think that, you could probably be a little bit more optimistic than bearish in the current context, right? On Friday's open, we open here, we look underneath Thursday's low. Technically staying in this range. We've sort of not broken back out of the range. We're still inside. We're breaking Thursday's low. This is exactly where the buyers show up. And then what happens? We close back above 390, 350. So again, sellers kind of lacking that follow through, and the bulls still have some work to do. I would not be overly bullish on this chart until we once again can get some higher lows back above 396.50. Why is that the level? Because that, of course, is where the larger FOMC breakdown took place. This was short squeeze. We'll talk about why on the internals in just a second. But what's the sort of underlying psychology of all of this? Well, number one, We had a banking crisis that was trying to resolve, and the narrative out there is definitely more bearish than bullish, right? The FOMC rate hikes, they're strangling the market, everything's going to blow up, the banking crisis, this, that, the other thing. Well, considering the narrative being overly bearish, on a number of occasions, specifically taking out Thursday's low, you would have imagined that the sellers could have or should have stepped in with more momentum and pushed markets lower. It simply wasn't the case. We remain in an hourly uptrend. You can clearly see sort of a channel that's developing that looks like this, and we're just continuing to be in the midpoint of this range. And with this suggestion, the failure of the sellers here, I would be a little bit more optimistic that something like this is totally reasonable into the earlier stages of this coming week. So the bearish narrative that is dominating the headlines is not producing significant sell-side momentum. Now, it doesn't mean that it can't do so in the future, but as traders, we need to be acutely aware of our own time frame, and in the shorter duration time frames, like trading an hourly chart, a 5-minute chart, a 15-minute chart, 5-minute, whatever you're trading that's smaller than the day time frame, I would say it makes more sense here to be slightly more bullish than bearish at this point in time. Very, very nuanced. I'm not saying that the market's rallying to all-time highs, but I'm saying based on the data points, it's confusing on the higher time frames. It's really more neutral. If we're looking at the small time frames, I do think that the bulls have a slight edge here. Now, because we're in a daily downtrend, let's talk about some scenarios that favor the bears first. If we reject here and produce a lower high underneath 396.50, yes, credit where credit is due. Of course, we have on the hourly chart a head and shoulders pattern. We're looking for 389, the neckline. When and if it breaks, we're just going back down to the lows closer to 382 from the banking crisis and hysteria back down in here. That's the bear scenario. Bulls, of course, as we've already alluded to, want to produce a higher low above 396.50 to cement themselves and say, hey, we're making progress in the upward direction. The hourly trend is intact. We're threatening a change, a reversal of the daily time frame trend. That's what the bulls want to see. The hourly uptrend remains here. If we get a higher low above 396.50, but we do not take out the 401 high, the daily trend flips to neutral. It is no longer a downtrend with an equal high. Right? So that's what we have on the upside. And obviously, although I don't think this is likely because the market's just way too volatile to be contained, if we stay in between these two numbers, I think it's a little bit more difficult to make a strong determination, probably more neutral in between. So let's take a look at some supporting evidence. Exhibit A, as always, market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. Overall, the cumulative volume on the week closed extremely neutral, almost at the zero line, nowhere close to 500 million positive or negative. This is incredibly neutral from a volume flow perspective. Notice that the advanced decline line spends some time above the zero line significantly here, tangled up from top to bottom, back to above. Very, very neutral. This is much more of an indication of volatility in the markets, not so much any apparent trend. Neutral and volatile is the takeaway there. The ticks are really interesting. Obviously, from a high level perspective, these are just very neutral builds early on in the week. Gets pretty bearish into Thursday's close, and then slightly, neutralize that into Friday's close. But the key takeaway of why I don't necessarily think new money buyers are stepping into this market, which is why we're still skeptical of those bullish rotations, is if we take a look at Thursday's tick specifically, notice here that the tick is consistently moving lower throughout the course of the day. Okay, well, let's zoom in on Thursday's session. This, as we're getting ticks that are driving lower, would indicate to me at least that this is short covering and not new money buyers stepping on the gas, looking for new long entries in this particular marketplace. So no new money buyers that are abundantly obvious, right, entering this market, volatility in here, and really a lack of directional flow. To me, it does strike me as much more neutral for our market. Exhibit B is the market profile video tutorial in the top right-hand corner if you're not familiar with this screen or the terms we're about to use. The primary takeaway here is where have we settled in relationship to the FOMC spike? Now, a mixed bag, once again reaffirming the lack of follow-through from both sides. On the Thursday session, value area is above the spike, point of control is above the spike, overlapping to up on the value area. On Friday session, the value area is overlapping to down and the point of control is underneath the spike. So right off the bat, that's not really the most clear indication there. What else could we say about this? Well, Friday, technically we have a poor high here. There's a lack of material excess. We've already cleaned up this poor low. So, if we do crack and stay above Friday's high, maybe we get that more optimistic look that we were talking about on the hourly time frame chart. It's a consideration, but we might also just get hung up around the point of control from the FOMC move, which is roughly 40-30 in our ES. Another takeaway here is that sellers painted themselves into the corner on the Friday session. This is a classic 45-degree line, thanks to Jim Dalton and Peter Resnicek for bringing this one to our attention. It's an observation where the sellers get shorter and shorter and shorter at worst location. This is not really indicative of new money buyers entering the market. Once again, this is more indicative of short squeeze, if anything, as we rallied into Friday's close. Nothing about the the profile is also an obvious indication of new money buyers. So with a lack of new money buyers, with a lack of nuance in terms of how the spike was resolved from in here, I don't really think it's fair to make a directional assessment based on what's taking place. It's really just a wait and see type of market at this point. We'll be constructive over the highs, or we'll be, a little bit more bearish underneath the lows. But as of right now, things are holding in there. Lack of clarity. Jumping back on over to Thinkorswim to evaluate the weekly performance of our sectors, we'll notice at the top of the list we see communications, energy, and the tech sector. Two of those sectors, tech and communications, obviously really heavyweight risk on sectors. The outlier is energy, a lightweight defensive sector, so kind of mixed posturing up here at the highs from a weekly performance perspective. At the bottom of the barrel is real estate and utilities, both really light and defensive asset classes. And then we have financials, which is a heavier weight risk on sector, obviously continuing to catch some headwinds based on the banking crisis. So just at the bottom of the barrel, we are still getting a mixed bag of posturing perspective. Let's take a look at the structural charts and evaluate what's going on from a trending perspective. Obviously on the XLC, a lot of important work was done here off of the higher low on the weekly time frame above 52. I've got to give credit where credit is due. This honestly did a significant portion of the work in keeping the S&P afloat as the banking crisis unfolded by rallying so significantly. Now, moving forward into the coming weeks worth of trade, this is bullish consolidation. There's really no threat to the XLC unless we break down underneath 55 and start producing lower highs underneath. That would be a cause for concern, but we're yet to see that, and nothing about this chart in the short term based on these three bars right here would suggest imminent breakdown coming into here and of course threatening those lows at 52. So all things considered, this does strike me as a bullish data point, even if we see a reasonable and mild pullback early into the coming weeks worth of trade. Next up is the energy sector, which as we know is more D for defensive. It's a lightweight sector. We don't want it exhibiting leadership. Even though this outperformed from a percentage perspective, is this threatening structurally leadership in our market? And the answer to that question is absolutely not. It's still well underneath the overhead balance range from in here. This does not strike me as a big deal for our markets. XLK, the tech sector, the heaviest weighted sector of them all, getting a break of a weekly bull flag from in here, producing higher highs, closing the gap from in the past. Nothing about this chart strikes me as a big bearish data point for the market that could potentially pivot things massively in the downward direction. Now, because we've produced a higher high, we can certainly afford some kind of higher low pullback. The concern is, just like everything else, if this turns into a look above and fail, will the bears actually see follow through into 135? We'll take it step by step, but as of right now, overall this chart, if we zoom in on the price action, after two back-to-back inverted hammers and testing the low on Friday with no follow through from the sellers, I'm not convinced that there's just going to be an outright collapse in tech, especially with the TNX, the 10-year rates right now, falling underneath a flush point. We'll get to that chart in just a moment, but so far so good in the heaviest weight risk-on sector for our market. XLB materials, what's going on here? Certainly more of a bearish looking chart, still underneath the overhead supply, putting in bear flag consolidation down on the lows. As long as it's underneath 77, it will exert some bearish pressure for the market, but it's such a lightweight sector that it's not going to be overly meaningful as long as the XLK is still performing quite well. The XLV, the healthcare sector, is getting caught up at the bottom of the monthly balance range, right around in here, around 125. As this continues to go sideways, technically that's A-OK for our markets. If it starts to break down, pair that with a weak XLF, bigger cause for concern. So the fact that this is going sideways here does strike me as being more bullish than bearish. We've also talked about on the channel how if we are going to move into more of a recessionary type theme going forward throughout time, right, technically healthcare should be an outperformer in those conditions, which would be bullish. And as the second heaviest weighted sector for the S&P, technically it would keep the S&P afloat as long as we're also seeing that outperformance in the XLK. So no concerns yet in the XLV. If it breaks down, once again, we will change our tone, but as of right now, things are looking A-OK. XLP, hard to say anything really constructive about this chart. This really sums up the nature of the market right now to me. I mean, this is just barcoding back and forth, more constructive over 74 or underneath, what is this, roughly 71, until it does something impressive, neutral, moot point for our markets. Next up, the XLY, what's going on from the discretionary perspective, much more of a cause for concern, really not finding as clean of continuation in the upward direction, but also getting more of a severe pullback into the later stages of the past week's worth of trade. It's in the midpoint of this overall range. This is something to keep a very close eye on. This is bearish drag for our market. This is a cause for concern. And early on in the coming weeks worth of trade, if you're a market bull, you want to see it resolve 141.75 in the upward direction to be more constructive and possibly threaten a break back up and over 148. Spending time underneath, you know the deal. It's just a big H pattern. It's a bear flag, whatever you want to call it. 135 is obviously a threat in the downward direction. Next up, XLI. What's going on in industrials? Very similar to materials. Obviously, it's not the same industry, but the chart pattern pattern is getting fairly similar with some consolidation towards the lows underneath the overhead supply. Call it a bear flag, call it whatever you want. It's not the most optimistic looking chart for our markets, and this, of course, is a little bit heavier weight. This is 8% compared to the sub 5% materials, so not the most ideal situation going on in industrials. Ideally, this turns into a look below and fail. So here's a big range, look below and fail. Obviously, the buyers didn't make it happen here, but if we get another one, look below and fail, does it turn into a double bottom? Obviously, your constructive look is taking out the neckline here much closer to 99 for bullish pressure in our market. Next up, real estate. It is a risk off type, or I shouldn't say risk off, but it's definitely more D for defensive in terms of posturing. Has much more to do with the wealth effect. As this moves lower, technically it should in theory tighten financial conditions as people feel their wealth evaporating, so to speak. So this is actually helping the Fed's mission, and obviously this is sort of on the rate hike. We moved lower here in real estate, so it should make sense. But overall for the S&P, it's such a lightweight sector, it's not going to make a difference one way or another. Just note that the wealth effect is probably more pertinent from that particular look. XLU, just like energy, this is a D for defensive and lightweight sector. We don't want to see it outperforming. It's lower on the list. It's not outperforming from a percentage perspective, but is it outperforming from a structural perspective? The answer is still no. So this strikes me as fine. This does not, look overly defensive in nature. It does not look like a huge flight to safety yet. Now, granted, on Friday it had a really, really nice up day there. It technically on Friday as an individual day outperformed tech, tech certainly, right around in here. So maybe a cause for concern, maybe something to start watching, but as of right now, structurally, doesn't strike me as a threat yet. That's the key for this market, right? As of right now, the market's kind of sitting in limbo at a really nice balance point. We're going to learn something about these markets when we move away from these areas that have been highly contentious over the past couple of weeks. Here's the sort of kicker, the XLF, of course, the financial sector. We talked about it ad nauseum in the pre-market live streams. I tried to warn you in the Sunday updates, the Wednesday updates. If you're going to try to short the breakdown of this level, do it with, premium positioned for zero, positions going to zero. That's how you manage your risk. This is exactly why. We undercut the low, and what happens all day? Oversold breakdown. We rally right back that, up to the breakdown point. I'm not saying it can't continue lower. As a matter of fact, you technically have the threat of a, sort of break, retest, and then continuation if we find lower highs underneath 31. But Friday was not the day to get short inside of financials. So we'll see how this sort of develops moving forward. The big threat is that if we get back above 31 with any definitive strength early on in the week, you bet your bottom dollar there's going to be a short squeeze that, probably takes us closer to 32, the top of the range in here. That would be something to watch out for. If we remain underneath 31 or there's just really no short squeeze that initiates, okay, fine. I will concede that yes, this is obviously bearish down here, and we'll look for continued deterioration in the financial sector. Here's the ratio grid. If you don't know what this one is, top right hand corner's got you covered with a brief tutorial. Overall, the top four are the risk on heavyweight sectors. Notice that the XLK is really the glue that's holding together the risk on look here. XLV is trying to find a bottom, but it's certainly not trending in the upward direction. We've talked, numerous times about the pain in financials, and this is a cause for concern as of Friday's close, the slip in consumer discretionary. This is not really convincing from a full-blown risk-on type look. It's really this XLK up top, which is keeping us slightly optimistic about outcomes in the market. You're also seeing that outperformance in the XLC currently as well, much more closely related to the tech sector. If we take a look at the bottom four risk-off sectors, these are all sort of hanging in there sideways, right? This is going sideways here. This is trying to perk up. It did not make a new lower low. So risk-off is not totally out of the picture, but risk-on is certainly waning in terms of its effectiveness. And we can see something very similar if we take a look at discretionary over staples, so risk-on versus risk-off, essentially. This did give up the daily 50 SMA, which is upsloping here, but we're still technically above the gray bar. So it's not all bets off. It's not like everything has been lost here, but it's certainly not as strong as it was looking. It's starting to slip. We're keeping a very close eye on this. Obviously, as the market resolves this contention point, as has been the topic of today's video, we will learn something either way if it holds and rallies or breaks down and sees more aggression into like the 1.7 area. Checking in on the dollar, I just want to point out that we've sort of established now that the banking crisis is over, more of that traditional relationship where when the dollar goes down, equities typically move higher. And that's the case as of right now. It is subject to change as we get more regulations and more news that comes out about the banking crisis. But so far, the relationship does seem to be roughly restored. We'll be paying very close attention to that as we move forward. If we take a look at the gold contract, it's certainly confirming by staying up here on these high higher highs in a bull flag formation, which technically should put downward pressure on the dollar, which is bullish for equities. So as of right now, relationship restored, but again, not really assuming anything in this current market context. If we take a look at rates, I really want to show you the signal study chart. We've brought this up in the past before. It's been pretty darn spot on, right? The most recent turn of events here, as rates aggressively started breaking down, did produce upward outcomes in markets based on the relationship of what happens in the tech sector, which is the most heavyweight sector of the S&P as we know at this point. Now, the concern with this chart is when this turns into a big aggressive breakdown here, and it does not produce a bullish signal in the equities market, that's when you need to run for the hills and duck and cover, because what does that mean? Well, obviously the Fed is cutting rates because something is significantly wrong in the economy, which is not good for equities. So we're keeping that relationship in mind, but as of right now, in the short term, yes, we have broken down underneath this key support around 3.4 in the TNX, and if this continues to move lower, we would expect positive outcomes for equities as long as earnings sort of recession and sort of consumer spending is not on the market's top of mind. As and if the next earnings cycle comes into view and people start discussing, hey, these companies' earnings are shrinking, that's where things become concerning, and that's where the Fed rate cuts do not pair with outperformance in the S&P. Speaking of rate cuts, you can already see that the market is aggressively pricing in higher probabilities of no hike in the next meeting, roughly 88.2% here, and lower odds of actually getting that last 25 basis point rate hike that the SEP would allude to from the release on Wednesday's session. Now, recall specifically that Jerome Powell mentioned and made explicit note that, hey, we're changing our wording from ongoing rate hikes are necessary to tame inflation to some policy firming may be required to adjust for inflation as we move forward. Something along those lines. He was very clear that although the SEP projects one more hike, he could easily come out with a pause in the next meeting and still maintain his credibility. Note also that the meeting is in May, early May, but there is no April meeting. If we go out to the probabilities, we'll still continue to see here that aggressive rate cuts are being priced into the back half of 2023, which of course is a cause for concern, signaling that, hey, the market believes something something's really bad about to happen. Not just the banking crisis we've seen so far, but more things are about to break. As of right now, we've sort of covered all of those fundamental data points. We really want to focus on PCE inflation on the Friday session. How is our risk appetite? Notice that the TLT is remaining high and tight on the relative strength line in this overall zone after falling off in here. So there's still some semblance of quote unquote flight to safety taking place right now. But just imagine if the Fed is forecasted to cut rates aggressively in the back half of 2023, you should probably expect the TLT to break out over this 110 area. It just simply hasn't happened as of right now. If it does happen, we will monitor very closely. Is there relative outperformance to the equities market? And if so, by how much? That'll tell us something about whether or not we are seeing risk or no risk in equities. Now, this is a wait and see type chart. Are we going to break 110 or are we not? Another wait and see type chart is the HYG, our other risk sort of gauge, if you will. Notice that it's sitting sideways in this overall range. It's towards the lower third of the overall range, but nonetheless, it hasn't broken the highs and it has not broken the lows. We'll wait and see if this confirms a move higher in equities or a move lower in equities. As of right now, it's a patience, sit on hands type of chart. If we take a look at what's going on in the Bitcoin chart from a risk appetite in the digital currency world, notice that we had a large breakout bar, and last week we've just consolidated and held on to all of those gains. This would speak to higher risk appetite in our market, considering that we weren't getting a lot of information from the TLT or HYG. Just recall that this has much more of a higher degree of correlation with the NQ, NASDAQ, obviously, and not so much with the S&Ps, but it's one data point to add into the overall narrative of market analysis. As we've been calling out in the past couple of weeks, the market breadth looks horrendous here, with new highs versus lows making a new lower low in this indication, morphing into much more of a concerning look like what we saw in 2022. Kind of speaks for itself there. If we take a look at what's going on in the SPX A200R, what I want to do is leave it zoomed out just to make the comparison. It's a very rough comparison, but it is a comparison nonetheless of what took place in 2008, right? In here, this is where you get back to the 50% mark. Granted, there's much more of a recapture in the more recent time, But as you fail back down underneath, lower high, that's where we get the plunge. If we get a lower high, could we see a plunge? It doesn't guarantee anything, but certainly would not speak to bullish odds as we move forward through time. Obviously, the more companies that are trading underneath the daily 200 SMA, the more concerning that is for the S&P 500. Anyways, moving along to the SPX A50, our stocks trading above their 50 SMA. This is a daily time frame chart now. We're not going to make any long-dated comparisons. All this would say is that, hey, as the markets rallied here over the past week and a half, 2 weeks or so, really it's just been a counter trend type move in an overall daily downtrend here. There's been no aggressive recaptures of the daily 50 SMAs across the market. That does not give me a warm and fuzzy feeling about new longs entering in a significant fashion. If we take a look at the RSP equal weight S&P 500, we're still underneath, even after this rally, we're still underneath the December low in the equal weight S&P, which would say, hey, tech is supporting this market, communications are supporting this market. If those two things start to fall, you better look out below, because this is already underneath. Even on the day-to-day, like into the end of the week on Friday's session, we made a new swing low in the equal weight S&P, whereas obviously in the regular weighted, we are well above this swing low in here. So this, a really big red flag, if you will, for the markets if the XLK, if the XLC start to dramatically underperform and see significant and aggressive pullbacks. The same thing can be said about the Dow divergence. If we take a look at this chart over here, they're dramatically out of sync. This is another one of these wait and see type charts, but notice here we have a higher low, and here we actually have a lower low. So out of sync, not confirming anything at this point in time. This market needs more information, and it needs a definitive push away from this area of balance if we're going to start to see more constructive looks develop. Checking in with the VIX and volatility, just recall that early on in 2023, 2050 was acting as a ceiling, and now it is acting as a floor. That is some sort of indication of discomfort from our markets, and that things are not fine and dandy, and that the market is not poised for just straight up continuation in the upward direction. Now, we could continue higher, but it's not going to be easy, and that's what volatility is telling us here. If we take a look at the VVIX volatility of the volatility index, this is a slightly more positive indication, closing the overhead gap and reversing off of it back down underneath 103. We want to see it continue to deteriorate and get back down comfortably into this range here if we're expecting more positive outcomes in the S&P. If we take a look at volatility futures, we are out of backwardation, thank goodness. This is a step in the right direction, but recall that short-dated options, 0 DTEs, whatever, are not going to show up in your VIX, which tracks 30-day plus options on the S&P, right? Calls versus puts, and the implied volatility that's there. So this may be neglecting to reflect some of the short-dated volatility in the markets, but overall, moving firmly back down underneath the zero mark from in here, no longer in backwardation up at the top. And even in the short-dated VIX, 9-day versus 30-day VIX here, we are underneath the zero line. So it steps in the right direction for more comfort being found. But as we just saw in the VIX itself, I would not quite just, surrender and say, fine, everything's fine and dandy in the market just yet. Rounding out the broad market with the QQQ and then the IWM, just notice that we did not make a new closing high above 311.75 in the past week's worth of trade. It doesn't mean that it's the end of the world in the QQQ, but you might want to watch out for a pullback underneath the two equal lows that comes into the 300 area. When and if we get there, I would certainly be looking for reversals considering the overall relative strength in the tech marketplace. Note also, it would just be a break and retest of the neckline of this double bottom pattern from back around in here. If we do see continuation over 311.75, the target overhead is the upper edge of the weekly expected move and prior structure at 320.50. For bears, it's obviously got to be a violation of that neckline with a lower high underneath that, 302.75-ish zone for more constructive bearish looks. Next up, IWM Russell 2000 and the small caps, just like the XLF. Hopefully you traded this responsibly at the lows if you were looking to short this thing with an options position that was sized for zero, and that's exactly what took place. Big snapback in the upward direction. I would watch out early on in the week for any continued price acceptance above 171 to potentially offer a short squeeze of anybody who got overly giddy at these lows to close out into 176.75. Now, we've seen failure patterns on the upside and the downside in all of the markets we've been assessing so far. I would not bet my life savings on this. I would minimize the exposure to that potential trade and just be aware that it's a dynamic that's in play as we move into this upcoming week. Weekly charts side by side show us a sideways S&P, a higher high QQQ, and a lower low IWM. What does it all mean? It really boils down to two words. I'm a big fan of these words. I say them here on the channel all the time. Manage expectations. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that said, we'll dive right into Apple. Notice that we definitively have the break of the weekly bull flag consolidation here. We've got inside bars into the Thursday and Friday session, so very simple trade here to watch for. It's either a long up and over the top at 162.75 for continuation into our prior target here, the breakdown point at 167, or a short underneath the lows. This is where it gets tricky because you do have the top of the range to be watching for, being mindful of on the hourly time frame chart. You can see that, yes, we do have a flush point here, 158.25, but are we just going to get a break, retest, and then move away from 156.50? So the short side is kind of tricky here on Apple, probably favoring longs after some more respectful consolidation, or heck, even watching for the breakdown and then a reversal off of 156.50 being in the breakout, the context of a breakout from the weekly pattern that we just discussed. Here's Netflix, completely blew me away on the Thursday and Friday session. I had no expectations of a big outperformance like this, but hey, we're dealing with the chart in front of us. Technically, this is starting to become, or it has become, a double bottom. The more respectful entry would be a confirmation of this pattern with a higher low anywhere above this zone around 315.50 and 312. That's what I'll be watching out for early on in the coming weeks worth of trade. Not sure that I would want to be a new money long pressed up against the 50 SMA and this prior structural area of resistance, and was prior support in here as well. Resistance, right? So kind of a patience play. Ideally, we get a higher low pullback entry for continued longs in Netflix as we make the turn here. Next up, we've got Tesla. What's going on with Tessie and Mr. Musk? Back inside of the overhead balance area in here. Nice hammer candle on the Friday session after undercutting the Thursday low. This is a partial gap fill as well. Because of all of that, I would watch out for early on in the Monday session, early on in this week's session overall, seeing if we can take out Friday's high and move back into 200. 200 will be a breakout point because of the two very precise touches on the Wednesday and Thursday session. If that gives, we're just expecting a rotation to the top of the range. Overall, the pattern would look something like this. Look below, fail into the range, target the top end, 213 daily 200 SMA as well. That's Tesla on the downside, obviously falling underneath. It's patience for a short under 173. You can start to imagine that maybe it looks like a head and shoulders like this. Next up, Google. What's going on with the Goog? You can see that we're well above the neckline of the double bottom pattern. We are sitting up here after a secondary push, right? So push number one, little consolidation, push number two. Do you ever want to be a new money long into the third leg of a move? Probably not. Probably not. You don't want to be a new money long chasing this at the highs anyhow. So respectful consolidation, fine. Give it some time. Maybe it turns into an hourly bull flag. We take the break and we manage expectations, just remembering that, hey, we're getting involved at pretty bad trade location. We've got some consolidation. Maybe we can go for it, but just keep a tight stop if that's how this one unfolds. The more optimistic look would be a breakdown of this low. So a failure from the buyers to hold this area around 103.75 produces a pullback to find some sort of higher low above 100. If that were the case, that would be ideal. Then the rotation is just back up to the equal highs and looking for continuation after that. So watching for a pullback in Google for a more respectful long-sided entry. Next up, we have Meta. What's going on with Zuckerberg's Fantasyland? Just like Apple, a couple of inside bars into the close of the week here, but notice that each one of them produces a higher low. Obviously, that has much more bullish implications than bearish implications. So a break over these highs at 207, there's quite a ways to run overhead into 221 as a target. Anything that just remains up here is bullish consolidation. In the grand scheme of things, spending time above the earnings gap up range from here. Next up, NVDA, the unstoppable of most unstoppable AI frontier, this, that, the other thing. It's all there, right? AI is the perfect recipe. And if you've been short AI, or short NVIDIA, I should say, it's just not working out well for you by any stretch of the imagination. So I will continue to reaffirm that this is not a stock to short. Is it a new money long? Probably not, for all the similar reasons we just discussed in Google. Not only has it seen a massive run from here, earnings gap up, it held a secondary push, another push. Just notice that we're not really getting any longer solid green-bodied bars, right? This is confidence. This is confidence. Solid green-bodied bar, solid green-bodied bar. As we're just hanging out up here on these highs, but we're not actually printing solid green-bodied bars, you're losing confidence in the long side momentum. Sure, it's gapping up. It's kind of holding up some progress in the upward direction, but intraday, very difficult to trade in the upward direction. So manage expectations here. I would not be a short, but I also wouldn't be a long, waiting for more information out of NVIDIA. Once again, think about the dynamic of the marketplace. If this does experience more of an aggressive pullback, it's not going to fail the uptrend here if it breaks to 242, but intra-week, it could be enough bearish pressure to have the Qs pull back. With the IWM already weak, the S&P may resolve lower if that's the case in some of this heavier weight tech type cohort. Next up, Microsoft. What's going on with Softy? Same idea, but a little bit stronger, obviously. Experienced a pullback. It's gobbled up the inverted hammer right up at the highs, right? Looking for the gap to close over 282.30, closes to 285.55, continuation after that 294. This chart actually strikes me as being much more tradable because of the consolidation and the fact that we did already experience a pullback, a meaningful pullback underneath an inverted hammer low. So all things considered, this is probably more favorable for upside continuation. Even Amazon, last but not least, the mini beast. What do we see over here? Same idea, right? Considerable consolidation. It's gone sideways long enough. It's not overly extended like everything else. It's not an NVIDIA by any stretch of the imagination. If it wants to play catch up and break out over these highs around $100.75, 101.50, fine, look left. There is some room to run into the daily 200 SMA. 108 is the target. And then failing underneath Friday's low does get interesting for a, you guessed it, look above and fail back to the bottom end of the range at 90.10. Time will tell, but ultimately this is a tradable setup with a clean balance range in place, over or under. Last reminder to hit the thumbs up button, subscribe button, bell button, all that good stuff YouTube tells us to tell you about. And let's dive right into these trade ideas. ADBE is up first for Adobe. This is a update from the Wednesday video. Recall that we were looking for more pullback off of the bearish engulfer into this area of support off of the double bottom neckline. Obviously, we never made it there. So considering that the sellers did not materialize and push prices in the downward direction, and that we do have higher lows coming into this pressure cooker top at 375, I would say that a break of this level should, in theory, bring us closer to this set of highs here at 385 sooner rather than later. Not interested if we never break 375 in the first place. So a quick update there on Adobe. And the last one is PG, Procter & Gamble. This was another trade idea that we brought up, it seems like a couple of weeks ago now. We were talking about this as a balance range and this high being in play. Obviously, we broke it in the upward direction, and now we're moving through, or continuing to try to move through, the thin structure off to the left. I don't want you to forget about that target at 149.50. With the break of a daily bull flag pattern on the Friday session, we're looking for continuation through the thin structure. I'm not saying it has to make here all in one go. I'm saying longs are probably more favorable in PG as opposed to short. So that's the second one I've got for you. That's all I've got for you on today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a thumbs up. Go outside, enjoy the nice weather, bright sunny day, certainly starting to feel like spring here. So hopefully you can enjoy some of that as well. With that said, everybody, I hope to see you in the pre-market live tomorrow morning at 8:30. I wish you all a green trading week.